This PowerPoint is made by Wenjin Jiexin Wang, Yinlei Xu, and Zhao. We present the general information about ANZ and concentrate on analyzing the financial statement of ANZ based on looking through its annual report in 2010. ANZ is a major Australian-based bank established in 1835 and one of the world's 30 largest banks with more than 6 million customers and 40,000 staff in more than 30 countries. Now let's talk about its principal activities. The group of ANZ provides a wide range of banking and financial products and services to retail, small business, corporate, and institutional clients. The principal activities are geographically focused on the home markets of Australia and New Zealand, and also exist in Asia. That is the fastest growing region in the world. Besides that, ANZ also operates in some other countries, such as United Kingdom and America. Exclude ATMs, there was 1,394 branches and other points of representation in worldwide at 30 September 2010. Generally speaking, ANZ is a quite profitable organization. There was 4,501 million consolidated profit after tax attributable to the shareholders of the group for the 2010 financial year, and the number increased 53% than last year. To be detailed, the profit before income tax is 6,601 million, and the income tax expense and non-controlling interests are 2,096 million and 4 million respectively. The profit before income tax deducts tax expense and interest expense is consolidated profit after tax. After glancing the summary of ANZ, it's time to look into some detailed information.
In the first place, let's look at the top line Michael Smith. Michael has been appointed as Chief Executive Officer of Australia and New Zealand Banking Group Limited since October 2007. Mr. Smith is a pretty experienced officer. He joined the HSBC Group in 1978, and during his 29-year career, he held a wide variety of posts internationally, including appointments in commercial, institutional, and investment banking. The remuneration of Michael Smith is quite considerable in the ANZ Group. It is formed by 3 million fixed payments, 3 million targeted short-term intensive, 3-year access to long-term intensive, and other grants. His total cash remuneration in the 2010 financial year is comparatively higher than his counterparts in other Australian major banks. The details are displayed in the form. Auditors play a very important role as well. KPMG Australia provided an external audit as the independent auditor to the ANZ Group. For the financial year 2009 to 2010, the total compensation was 15,026,000.
The graph indicates ANZ Group structure. The group is formed by controlled entities and associates. I will give some details in next slide. ANZ Group has 52 controlled entities as at 30 September 2010. There are 47 subsidiaries. Let's have a look at associates. ANZ has 7 significant associates. They contribute 94.27% carrying value to total carrying value of associates. On 30 November 2009, the group acquired the remaining 51% shareholding in the ANZ RNG joint ventures in Australia and New Zealand, taking its ownership interest to 100%. For the period 1 October 2009, ANZ does not have any jointly controlled operation and assets.
Now the question comes to goodwill and cash generating units. You can see from the table the consolidated goodwill is 4,089 million in 2010, and goodwill and intangible assets with indefinite useful lives are allocated to cash-generating units for the purpose of impairment testing. In respect of goodwill, the cash-generating units are based on the operating segments of the group, which are the major geographies in which the group operates. A cash-generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets. There are no impairments of goodwill in the 2010 financial year as table shows above. Now let's look at next slide. This slide is about tax consolidated group, which is quite simple. The answer is the company and all its wholly owned Australian resident entities are part of a tax consolidated group under Australian taxation law.
Now let's look at the segment disclosure of the group. According to the AASB 114, reportable segments require disclosure of financial information in relation to the business and geographic segments of an entity. ANZ Group has its segment disclosure mainly based on the geographic regions, namely Australia, New Zealand, Asia Pacific area, Europe, and America. As we can see, in the meantime, each geographic region can be also classified through the characteristics of customers. The divisions are based on retail, commercial, wealth, and institutional.
This is the last part of our presentation, accounting method. First, we have to understand what is subsidiary, associate, and joint venture. Because different commercial entities have different accounting method, the subsidiary is the investee entity over which the parent entity has acquired power to control. Control is presumed to exist when the parent owns, directly or indirectly through subsidiaries, more than half the voting shares of an entity unless, in exceptional circumstances, it can be clearly demonstrated that such ownership does not constitute control. An associate is an entity over which another entity has the power to exert significant influence, which is defined as the power to participate in the financial and operating policy decisions of the investee, but is not control or joint control over those policies. A joint venture is a contractual arrangement whereby two or more parties update an economic activity that is subject to joint control. Now let's turn to accounting method in consolidated accounts and parent entity accounts. With regard to accounting method in consolidated accounts, as seen from the table, ANZ Group use consolidation method for the investment in subsidiary, by which it aggregates the financial statements of the subsidiaries with investors. And for investment in associates and jointly controlled entities, the equity method is used, which is a method of accounting whereby the investment is initially recognized at cost and adjusted thereafter for the post-acquisition change in the investor's share of net assets of the investee. The profit or loss of the investor includes the investor's share of the profit or loss of the investee. About accounting method in parent entity accounts, acquisition method is used for the items of the investment in subsidiaries, which is defined in AASB 3. Under this method, the acquisition has to be valued at fair value, and the difference between purchase price and fair value has to be recognized as goodwill or discount on acquisition. Furthermore, cost method is applied in the separate financial statement of the investor for the item of the investment in joint venture and associates, which is defined in AASB 139 and 128. That's all. Thanks for paying attention to our presentation.